So 2 hats, 1 head, double the contribution capacity. Hi, I'm Phillip Smith, financial planner with Tidepool Wealth Strategies, helping people close to retirement create a tax-smart, dynamic retirement planning strategy with clarity and confidence. Welcome to
the perfect retirement plan.
Welcome. So you just paid that last tuition invoice. The mortgage is almost gone, or maybe it's even paid off. And your consulting income from that self-employment role that you've got going finally cracked 6 figures. Yet every extra dollar is still piling up in your business account, becoming a growing target that the IRS would love to pounce on next April. They say money talks, but when the IRS gets involved, you usually just see it waving goodbye. Today, we'll talk about turning that target into a solo 401k strategy that has the potential to shelter taxes, accelerate growth, and maintain flexibility in case life throws a curveball. And don't worry, I'll try to keep the dad jokes to a minimum today, if we're lucky. Stay tuned until the end, because I'll reveal a brand new Secure 2.0 quirk that offers the potential to put an extra 5-figure boost in your retirement balance if you act before next tax season. Here's the roadmap for today. And be sure to listen all the way through, because each of these 5 moves builds on the next. First, we'll hit those solo 401k fundamentals for proprietors close to retirement. Then we'll do chronological, I guess we could call it chronological. We'll do chronological walkthrough of the contributions. So employee, employer, catch-ups, and enhanced catch-ups. Third, we'll look at dialing your mix of pre-tax, Roth, and after-tax dollars. After that, we'll cover a detailed pros and cons showdown, the solo 401k versus the SEP IRA or the SIMPLE IRA. And we'll follow with plan loans, rollovers, and Secure 2.0 opportunities you can use this year. And finally, of course, actionable steps you can tackle this quarter. So grab your notebook or your AI note taker and stay with me to catch every tip. Let's wade in. So let's begin with some solo 401k basics for sole proprietors nearing retirement. A solo 401k is available to solo business owners with 0 full-time employees other than a spouse. Now, you wear 2 hats, the employee and employer, letting you stack far more cash than a SEP IRA or a traditional IRA or a simple IRA is going to allow, while keeping costs relatively low. So 2 hats, 1 head, double the contribution capacity. Try fitting that into a dad hat collection. Sorry. Topic number 1, supersizing contributions chronologically. So first, as the employee, you can defer up to $23,500, and that's the 2025 limit. Since you're 50 or older, tack on the $7,500 catch-up contribution for a total of $31,000. Choose pre-tax, Roth, or a blend of the 2 types of contributions. Second, as the employer, your business may contribute up to 25% of your net self-employment income, which comes to about 20% after the self-employment tax adjustment, until your combined cap hits $69,000 for 2025. Now, third, if you're 60 to 63 years old, Secure 2.0 unlocks an enhanced catch-up. That's the greater of $10,000 or 150% of the standard catch-up. With the 2025 numbers, that's an extra $11,250, pushing your potential solo K contribution near $80,250. Next, fund these layers in order: employee deferral and catch-up contributions by April 15th, as your cash flow permits, and then employer profit sharing contributions by your tax extension deadline. So that could be as late as October 15th of 2026 for a 2025 contribution. Topic 2, dialing the tax dial: pre-tax versus Roth versus potentially after-tax contributions. If you're just joining us, stick around, because in our next segment, I'll compare these solo K tax buckets to other small business plans so you can pick the perfect fit: pre-tax versus Roth versus after-tax. Now, late career sole proprietors often straddle a high bracket now and a lower one later. And by bracket, I'm referring to tax brackets. Pre-tax deferrals can slash this year's Schedule C income and self-employment tax. Roth deferrals skip the deduction today but grow tax-free for life. Great if future Roth conversions would nudge you into higher tax brackets. Now, I mentioned the tax brackets because converting from pre-tax money like a traditional IRA to a Roth IRA is a taxable event. Okay, let's talk about those after-tax contributions as well. Now, after-tax contributions are available if your 401k provider allows it, but these could be rolled to a Roth IRA when you close the business, creating a mega Roth opportunity. You may have heard this before. You can look it up, something called a mega backdoor Roth. It's a bit of a unicorn in the retirement savings world, but if you have access to after-tax contributions, this is a unicorn that you might be able to capture. Now, you can start by pitching in enough pre-tax dollars to land you in your target bracket. Oftentimes, this is maybe 22% for married filers. And then you can funnel the rest into Roth. Add those after-tax contributions only if cash flow is stellar and if your plan permits in-plan Roth transfers. Now, you could think of it like a faucet. If you have too much cold water, pre-tax dollars, then your future taxes are going to scald you. If you have too much hot water today, Roth or after-tax contributions, and you lose some relief. So you want to aim for lukewarm, Goldilocks approved water. You want to get the right mix of pre-tax and after-tax savings. Topic number 3, solo 401k versus the SEP IRA and SIMPLE IRA. Let's just do a down and dirty, quick pros and cons showdown. This is going to be just a 3-way comparison, so hopefully I don't confuse you listeners out there. On contribution muscle, the solo 401k combines employee deferral plus employer profit sharing contributions. A 55-year-old netting $200,000 in income could stash $71,000 in total contributions. Add in the enhanced catch-up contribution from ages 60 to 63, and you're flirting with $80,000 of contributions into the 401k. Meanwhile, with the SEP IRA, it's an employer-only contribution at a max of 25% of earned income. Now, depending on income and how you've structured the business for tax purposes, and therefore whether someone pays themselves a salary, an owner could be severely constrained by their own W-2 wages. In a simple IRA, it is cleaner. You have a deferral limit of up to $16,500 for 2025, plus the $3,500 catch-up contribution, and then you have that mandatory 3% matching contribution from the employer side. This is going to top out near $27,000. That's like showing up to a buffet with just a limited sized lunchbox. So let's talk about those Roth and after-tax options. Solo Ks allow Roth salary deferrals, and with the right plan design, you might have access to after-tax contributions plus in-plan Roth conversions or Roth rollovers. The SEP and Simple only recently began to allow for Roth contributions, but that new money source makes those plans a little less quote-unquote simple to manage. And there is no way to do above and beyond after-tax contributions. Now on the catch-ups, the Solo K offers the $7,500 standard catch-up and that shiny new $11,250 enhanced catch-up. The SEP IRA has no catch-up contribution. Simple IRAs have a skimpy $3,500, or if you're in that 60 to 63 range, that limit is currently $5,250. That's a ways off from $11,250. Regarding flexibility and loans, the Solo K, you can borrow up to $50,000 or 50% of your balance. The employer share is completely discretionary. And, with the SEP and Simple, there are no loans. With any IRA, you cannot take a loan out against that IRA account. And again, SEP and Simples, they are SEP IRAs and Simple IRAs. So the Simple also is going to force a match even in your lean years. And so the consideration there is on the side of the Solo K, the employer contribution, I just briefly mentioned it, but the employer contribution is discretionary. It means you can choose how much and whether or not you do anything at all from year to year. The SEP is going to be consistently flexible in the sense that you can always choose a percentage or a dollar amount that you want to put in from year to year. But the Simple, again, is going to force a match. The requirement is you have to do the 3% match in 3 of every 5 rolling years. You can go as low as 1%. Otherwise, you just basically have to shut down the plan for a year, but that means no contributions as well as no matching contribution. Okay, that was straying off a little bit. Then considering administration and cost, the solo 401k is relatively easy to administer. I mean, it's not as complicated as a full-blown 401k. You have one form 5500 EZ that's due only if your assets exceed $250,000 in the plan. And annually, you're going to see about $500 to $800 in fees for record-keeping services. Now, the SEP IRA and the Simple IRA, they have 0 filings that you have to do, and that is typically near 0 cost for administration. So very low cost, very easy to administer for those IRA retirement plans. Another important consideration is how future staffing could impact the plan itself. With a solo K, you can always end up converting to a traditional 401k plan without retroactive funding when you hire someone. The SEP IRA must fund the same percentage, or they say an equal amount, whether it is the same percent or a same fixed dollar amount for every person on staff, which could put, a bit of a crimp in that ability to max contributions, unless you want to give yourself 25% and also give 25% to any of those new hires that you bring on. Simple IRA plans structured with the matching contribution require matches for all eligible employees. So here's a quick recap. Solo 401k wields the biggest shovel and a greater number of tax tools that you can play with. The SEP and Simple IRAs are cheaper to set up, but smaller and less adaptable when you need last-minute contributions. Okay, topic 4, smart loan and rollover uses. Now keep listening, because right after this, we'll unpack the latest Secure 2.0 tweaks that most sole proprietors still haven't heard about. Solo K loans let you borrow up to $50,000 or half the balance, as I mentioned before. Now, use this sparingly. Bridge a short property flip or emergency cash flow, sure. Funding a vacation, that's a no from me. Repay this within 5 years on schedule, or the loan turns into a taxable distribution with penalties if you're under 59 and a half. Now, if you snag a W-2 job later, roll your solo K into the new employer plan or into an IRA, then pay off any loan first, because Uncle Sam doesn't accept IOUs. Okay, topic 5. Thanks for sticking around. Secure 2.0 tweaks and hidden opportunities. First and foremost, I think it's important to note that there are mandatory Roth catch-up contributions in the 401k and 403b plans starting in 2026 for anyone over age 50 and earning more than $145,000 on their W-2. So if you're a high-income earner, you're maxing out your 401k contribution, you do not get to realize that pre-tax savings today, really just deferring the taxes until tomorrow anyhow, but you don't get to see that pre-tax savings today. It has to be a Roth contribution if you're making the catch-up contributions. Next, emergency withdrawals. So emergency withdrawals are now permitted. It allows up to a $1,000 penalty-free pull each year, which could be handy for a flat tire or unexpected expense, but I wouldn't recommend it for a Hawaiian getaway. Next, the 20% QBI deduction. It can vanish if you lower business income too far with pre-tax contributions. Sometimes shifting part of the employer deposit to Roth keeps the deduction alive. And it's important to note that with the new OBBA passing, yes, the One Big Beautiful Bill Act, since that is passed, the QBI deduction has been made quote unquote permanent. Everything's written in pencil when it comes to the tax code. But also, it's been increased to 23%. So now the QBI deduction is being bumped from 20% to 23%, which is pretty awesome for business owners. Secure 2.0 changes continue to roll out like Oregon road repair, slow and full of orange cones. So you got to know which lanes are open so that your tax savings don't hit a pothole. All right, there's lots to consider, and the right fit often depends on your specific situation. So if this applies to you, let's take some action on this. Yes, you have made it to the action phase. Well done. Here's how to put today's ideas to work. First, open or review your solo 401k. And when I say review, I mean review your solo 401k documents. Open a plan or review your documents. Words are hard. Also, note contribution deadlines. Next, set your employee deferral percentage in payroll software to max out by year end. Then, meet with your CPA to estimate employer profit sharing contributions before December 31st and reserve some cash for the deposit. After that, Map your pre-tax versus Roth mix to keep taxable income in your chosen bracket. And finally, if you are 60 to 63 in 2025, confirm your provider will enable the enhanced catch-up and update your budget. Now, in closing, I'd like you to remember, it isn't about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on, preferably before the next IRS due date. Oh, and I gotta squeeze this in regarding the Roth IRA to ensure I'm keeping compliant disclosures top of mind. A Roth IRA does offer tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal on earnings, what we call qualified distributions, a Roth IRA must be in place for at least 5 tax years. The distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, which has a $10,000 lifetime maximum. Depending on state law, non-qualified Roth IRA distributions may be subject to state taxes. Qualified distributions are 100% tax-free. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Tidepool Wealth Strategies or Tidepool Wealth Services, LLC. The opinions contained in this material are those of Phillip Smith and not a recommendation or solicitation to buy or sell investment products. This information is from sources believed to be reliable, but Tidepool Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities offered through Tidepool Wealth Services, LLC, member FINRA, SIPC. Advisory service offered through Tidepool Investment Advisors, LLC, registered investment advisor. Tidepool is under separate ownership from any other named entity.